Hey everybody, this is Brent from Wolf on Wall Street Trade with the market update for the week ending June 24th, 2023. Actually, this is more of a follow-up of a video I did early in June. It was basically a forecast of what we could expect to see in June and why it was important. If you're not familiar with my work or you're not familiar with my view of what's going to happen in this market in terms of three phases, phase one, phase two, phase three, where we are in that whole process, I would highly recommend going back, watching this video. June could be huge for the stock market. It was, I believe, June 2nd or June 3rd. It was posted here on YouTube. There's a lot of information in there, and it took hundreds of hours and months to come to the views that I have, and now we can see them coming to fruition in June. So that's what we're going to cover, but if you haven't seen it or you need to refresh, I would really recommend going back and watching that. Here we are looking at the NASDAQ 100. This has been by far the strongest performing index of 2023. It had pretty much the worst week this week since March. It's not a horrible week, but the real insight is not in what it did on the week in terms of percentage gains or losses. It was the tone, and we'll get to that. First, I kind of want to go back to that video from earlier in June and why a close above S&P 4200 was so important to the rest of what would happen in June. So let's pull up the SP 500, and here it is on a 60-minute chart. I believe that close above 4200 was right over here. The reason it was so important was because it was going to feed what was needed for distribution. Okay, so the things that it was going to feed was first FOMO, fear of missing out. So a lot of people have missed this rally since October. This has been an 8-some-odd month rally. Performance chasing, a lot of hedge funds have been short this because they have not believed it, so they need to chase the performance as the market continues higher. We had some huge, actually a record short position in S&P futures in the large specs, the non-commercials. So short covering. And then there's this whole, we're in a new bull market because we're 20% off the lows and all that. So all those narratives leading to basically people chasing prices higher. And what that creates is an opportunity for smart money to sell into price strength. So that was part of the whole reason we were looking for a close above 4,200. And you can see what's happened since then. If you look at the NASDAQ, it's even more extreme. The NASDAQ almost goes like vertical over here, but this is really not what we're concerned with. What we're concerned with is the tone of price action. Let me show you a couple other things real quick. As far as that short covering, remember I said above 4,200, we'll see short covering. Above S&P 4,300, we'll see more short covering. So S&P futures, the non-commercials, the large speculators, typically hedge funds, were the shortest S&P futures they've ever been. So as the S&P breaks out of this 8-week range, it closes above 4,200, it closes above 4,300. What do you think happens? They are at a huge loss. They start covering. It's a big short squeeze. Let's take a look at the commitment of traders. So this is S&P futures, the commitment of traders, non-commercials. Commercials basically are just like hedging. So these are large speculators. This over here is the largest S&P short position among these non-commercials, large speculators in history. Okay, that was at the beginning of June. So we have 1, 2, 3 weeks of massive short covering among these traders in S&P futures. That was what we were looking for. If you go back to that early June video, exactly what we're looking for. Short squeeze, which helps drive prices higher. That gives institutional money the opportunity to sell into price strength, which is called distribution. Now, where did I expect to see that first? I expected to see that first in the stocks that have gained the most on the year, which is the mega caps, the NASDAQ 100. So if we look at the NASDAQ 100 on a year-to-date basis, and our call actually at the end of 2022 was that the NASDAQ was going to outperform. Let's see if I got this right. Just about. So almost a 40% gain intraday. Yeah, 40% gain. So this is where I expected to see distribution first among the biggest stocks that have huge positions in institutional money. And this has all really been driven by these mega cap stocks. Let's see if I can get this pretty close anyway. And this isn't going to be on a intraday high, but 36%, for the mega caps just year to date. I mean, huge gains, right? So this is the area where I'd expect institutional money to start selling first, distribution. They want to do that into price strength. But first, let's talk about why would they be selling? Why would they be selling into the end of Q2? The gist of why I expect a transition from phase one, which has been from October to present, to phase two, these are my terms of what I expect in the market, is because I expect the lagged effect of monetary policy of Fed rate hikes, which in my view is 6 to 12 months. I've heard Fed presidents say it's 18 to 24 months before monetary policy, all these rate hikes are actually felt in the economy. And as I covered in that video at the beginning of the month, basically the economy was feeling a Fed funds rate of less than 1%. Fed funds rate is at 5.25%, 5.25. So all of that lagged effect is going to catch up. I also expected a pause in the Fed's rate hikes in June. I explained why we did get that pause, and I expected that pause to be sell the news event, which we have seen not so much in price percentage moves yet, but in the tone and in distribution patterns. My view has been, because of that lagged effect of monetary policy, of Fed rate hikes, that we will probably see, and this has been my view for well over more than just this year, going back to last year probably, is that we will see the U.S. economy moving more towards recession the second half of this year because of that lagged effect. So we actually got some data over the interim since I posted that first video of the June forecast that kind of confirms that. Particularly this week, we got a whole bunch of PMIs. So we've basically had a bounce in PMIs in both manufacturing and services pretty much since the start of the year over here. And if you look down here, you can see like the green one is the US composite PMI, the red one's the Eurozone, this other red one here is Kayaxin, that's China, S&P Global. But what you can see here is the bounce, right? And then all of these PMIs globally starting to turn down. So this is moving towards that expectation that I've had of moving towards recession in the second half of this year. Additionally, one of the most reliable recession indicators, which is the 2-10 yield curve, when it inverts like it did over here, we see recession almost every time. This is recession shading. Here is an inversion. This is the code crash, recession. So what we did see was pretty much the lowest level here of inversion, or the most inverted since the early 1980s. Got a little bounce, and then over the last couple of weeks here, we have come back down to the most inverted levels. So this is screaming recession. In that video, I go into a little bit more detail about the things that happened right before recession, like the sharp yield curve steepening, which is Fed rate cuts. Nobody is expecting Fed rate cuts right now, but I am telling you, they will be coming. It's really interesting that the Fed has hiked rates to the 5%, 5.25% corridor, because the typical rate cut that they need to deal with the average garden variety recession is 500 basis points, 5%. So I've been talking about this lagged effect of monetary policy. The Fed hikes rates, but it takes 6 to 12 months to be felt in the economy. And that's probably a little bit conservative. So what do we see in Bloomberg on Friday? Basically exactly what I have been saying for months. The market has not yet digested the lagged impact of tighter Fed policy. Co-chief investment strategist of John Hancock Investment Management, based on what we've seen in terms of this really strong run in markets, we would consider trimming risk. Why? Again, because of that lagged effect of monetary policy. So what we're seeing in the economy now, this kind of turn that we're already seeing in PMIs, is going to get worse and worse, because we're probably feeling about a 1.5% at most Fed funds rate in the economy. When that starts catching up to the 5.25, it is going to get really ugly for the U.S. economy. And my view has been that that will happen the second half of this year, which is why June Q2 transition from my phase one to phase two has been so key to all of my analysis. All of my hard work has already been done. Right now, we're just seeing the things that I forecast and expected, and you can go back to that early June video and see those things. One of my other strong views was basically that these things would get worse in June after the Fed paused rate hikes. And when I made that video and I said the Fed is going to pause rate hikes, I mean, the market was figuring there was a probability they were. I was sure they were. And my view was that things were going to get worse in terms of distribution after the Fed paused rate hikes. Why? Well, one, because the average investor is going to say, oh my gosh, the Fed paused rate hikes, that's bullish, I should buy. So now the question is, have we seen the things that I thought we were going to see in June? So far, yes. If you're a subscriber of mine to my website, or if you've watched enough of my videos, you'll know that one of my mottos, and this is just something I've seen over and over again over 25 years, is that changes in price trend are almost always preceded by changes in character. Okay, changes in character are subtle. They go unnoticed by many people, by most investors, by most traders, but they almost always precede a change in trend. Changes in character is what we are seeing in June. I'll show you some. Here is small cap IWM, which started to rotate in at the beginning of June. It had a really strong first week of June. We get this kind of rally, and then we get a bullish consolidation, right? This is on a 1 hour chart. I'm going to show you what's happened more recently over here. So here is IWM that was in a consolidation since basically the first week of June, while mega caps kind of rotated in. This is that consolidation right here, the trend line, and it remained bullish right into this week. And then all of a sudden, each one of these is a day, so it's a 15-minute chart. All of a sudden this week, look at what we're getting. So people are seeing IWM or small caps go down in price and probably not thinking too much of it. But if you look at the intraday trade, it's gone from a big bullish consolidation most of June to these more bearish kind of flags. They're like small bear flags. Each day, market drops, consolidates a bear flag, drops again, consolidates another bear flag, drops again. So this is what I call a change in character. They precede changes in trends. Let's take a look at the best performing index by far year to date, NASDAQ 100. Here is where the NASDAQ 100 rotated in, mega caps rotated in at the start of January, the start of a new quarter. And this is an important concept too, because a lot of institutional money rotates on either a monthly or more often on a quarterly basis. And we can see huge bull flag. This bull flag has a measured move, which is right here. So as the S&P closed above 4,200, guess what? NASDAQ met and exceeded its measured move. The most common thing to happen after a measured move is hit is for price to consolidate around it, which we're seeing right here. But now let's take a closer look at what the NASDAQ 100 has done in June and since the Fed paused rate hikes. So this is a 10-minute chart, NASDAQ 100. Here's the year-to-date measured move, tagged. You can see how price respects it. I mean, it stops right there at the measured move, pulls back, tests it, pulls back, tests it again. Right over here, this whole thing is looking more like a toppy pattern in the NASDAQ 100, which I have not seen all year. But specifically this week, what do we see? The same kind of thing. A decline, a small bear flag intraday. Over here, we have a 2-day bear flag, right? Another decline, and we're coming back down towards this year-to-date measured move, which we'll probably find a little bit of support at. Friday, again, another one of these bearish flags. Have not seen these all year in the NASDAQ 100. All of a sudden, they're showing up after last week's pause of the Fed rate hike cycle. And also, a week or 2 weeks out into the end of the quarter. If we look at the Dow Industrial Average, which actually led this whole rally off the October lows, it was the strongest performing index. It gained over 20% from October lows to the November high. And back then, again, the financial media, CNBC, were saying, oh, 20% off the lows. It's a new bull market. So we just saw that with NASDAQ, and we saw that with the S&P, new bull market, blah, 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 blah. I said, no, it isn't. Don't believe that crap. But that is what gets dumb money, the mom and pop investors, to chase prices, and gives smart money the opportunity to unload their shares to them. So what we did see coming into June is the Dow acting a little bit better. But let's take a closer look at what's happened recently. Coming into this week, here's the highs. This was also a triple witching options expiration the Friday prior, Friday the 16th, 4.2 trillion in notional. And I say this over and over again, the vast majority of options will expire worthless. So smart money tends to write options. Dumb money tends to buy them like lotto tickets. Okay, so smart money knows where they can make the most money if they pin prices. The price pin for the S&P 500 was above 4,400. Hasn't traded there since. We look at the Dow coming into this week. What do we see? Again, bearish intraday consolidations, like little small bear flags every single day of the week. Here we are looking at a 4-hour chart of the S&P 500. Here is the October low. The Dow and small caps actually had really stellar bases, double bottoms over here, but you can see bull flag, advance, another bull flag right here. This was a failed bull flag. Why? Because January saw inflation pick up and rates surged in February as all that data was reported 30 days delayed in February. So then we got into this 8-week kind of range. It started with earnings season, and we have earnings season coming up in a few weeks again in summer. It tends to be very dull, but what do we see? Again, close above 4,200, broke everything loose. So it took basically almost 8 weeks for the S&P to go from here to 4,200, which was 35 points, right? After that, up to 4,400 in 2 weeks, 200 points in 2 weeks. That is why I was saying it was so important to have a close above 4,200. You get dumb money chasing this. You get fear of missing out. You get hedge funds that have not believed this rally and they have been short it, which you can see in the commitment of traders data in S&P futures, that are forced to cover shorts, which I already showed you, and we get this big run. Now let's take a look at the S&P 500. What happened over here? It doesn't look like anything on this chart. It looks like a modest pullback, right? We get basically 1 day of trading above 4,400 over here into that massive triple witching options expiration with $4.2 trillion in notional on the table. So dealers had a lot of incentive to pin prices, max pain price pin on a triple witching options expiration because they stand to make a lot of money in premium. We come into this week. What do we see? Again, intraday bear flags almost, well, actually, every single day. We saw some real ugly price action over here Friday afternoon. Actually, not ugly price action. Price action wasn't that bad. The REIT-C charts were really ugly. They were showing a lot more distribution than what we see in price. I looked around for what could possibly be causing that, and it actually was this kind of potential civil war brewing in Russia with a private mercenary group going after the Kremlin. So that's something, maybe affects the market going forward. But the point is, before that even happened, bearish consolidations all week. This is stuff we have not seen in the S&P, in the NASDAQ 100 this year. Here we're looking at a 2-hour chart of the technology sector. This is the most heavily weighted S&P sector. Our rotation into January, where tech starts to outperform. Big bull flag over here, nice bull flag over here. Our year-to-date measured move from this bull flag is right there. So we hit that measured move coming into June, right? I'm going to show you a closer view. Here's the measured move again being hit and price respecting that. Interestingly, a small bull flag right over here, price pulling back right to the year-to-date measured move. That gives you some real insight into how strong these measured moves are. Price pulls back again. So this is kind of one of the first hints that something is not going right here, because we should have had a huge breakout and measured move from here. Didn't get it in tech, pulled back again. We finally did get this, but it is not anywhere near this measured move. We look at this week more closely, and what are we seeing? The same stuff. bear flag, a larger 2-day bear flag, decline into Friday, another small bear flag, massive change in tone, massive change in character. If you just look at the weekly chart and you say, oh, well, tech sector was down a little bit, it was due for a pullback. That is not important. The change in tone, the change in character is what is important, because these almost always precede changes in price trends. And here they are happening exactly when we thought. So go back to that June 2nd, June 3rd video, the forecast of what we expected for June, that we would see this kind of activity, and especially after the Fed paused rate hikes, which was back here. I'm going to show you one of the most influential stocks in the market, and I'm not picking on this stock. I'm not saying, look, this stock looks worse than any of the others out there, or it's a short, or anything like that. I'm just saying it is the most influential stock. It's a bellwether, so we're going to look at it. That's Apple. And here we are on a daily chart. So you can see, again, ugly performance into the end of 2022. Tax loss selling over here. January, everything changes, right? What I want to do is zoom in right over here, and I'm going to show you what on the price chart is what I call a distribution day. Let me pull up the volume a little bit, and let me back it out to year to date, which is January, right there, okay? So what we see, let me pull up a marker, is what I consider a distribution day. So first we have over here a small kind of doji star, and then we have a bearish engulfing candle. Then we have the biggest downside volume day of the year. So you can say, well, for every buyer, there's a seller. For every seller, there's a buyer. But what you can see here with this big red bar is that the sellers were the ones making the concessions. Distribution day. Apple's gained a little bit more since that. Distribution relies on stable prices or prices rising. Smart money has huge positions. They're not like you and I, we say, well, we got 10 shares of Apple, we're going to sell them, or 100 shares. It doesn't move the market, doesn't matter. They've got huge positions. They can't do that. They feed them out in a process called distribution. This is why I always say distribution is a process, not an event. So let me just pull up a pointer, and we're going to identify this day for Apple. That was June 5th. Now let's go to 3C charts. So here we see Apple on a 2-minute 3C chart towards the end of May. Positive divergence right over here. Apple runs up higher. This is that distribution day. We see some signs of selling into that day, some distribution in 3C. Not horrible, right? Price comes down over here. June 7th, we got a market-wide a little bit of accumulation in tech market-wide on the 7th, and we see this run up in Apple. Look at what has happened since then around the price area of this distribution day. A relative negative divergence right here. 3C is not making a higher high. And after the Fed pause and into the end of the month, 3C is starting to plunge here. That doesn't mean Apple is a short. That doesn't mean Apple can't gain more. There's still some signals that I expect to see. We still have a week in the month, a week in the quarter, and then we go into earnings. But this is what I've expected to see. Here's another mega cap, Amazon, right? 3C confirming price really well right into the end of May. What starts happening after that? Negatively diverging. After the Fed pauses, we are starting to get a leading negative divergence in 3C. So we're seeing exactly what I said I expected to see at the start of June. Right now, we have 7 mega cap stocks. That's including Apple, Amazon, Microsoft, Google, Tesla, Nvidia, and Facebook or Meta, whatever you want to call it. Those are trading right now at 30 times earnings in PE, right? The S&P is trading at 17. So you can see these stocks have really outperformed. And you can see why dumb money would be chasing the price trends, which look great if you just look at price. But you can also see that smart money is using that opportunity to sell into price strength. And if you're a member of or subscriber of my website, then you already know that we saw a massive change in character going from May right here to June 1 in the S&P and in the NASDAQ 100, where 3C massively negatively diverged. So this is month-end rotation. This is not retail money doing this. This is smart money. This is institutional money, big money that is moving this indicator like this. So we already saw hints of this very early in the transition to June. And now we're seeing a lot more of it as expected. Over here, if you're familiar with 3C and how it works and the concept of a divergence getting stronger, migrating to stronger time frames, you can see 3C tracking along with price over here. We get into June, and especially as the Fed pauses rate hikes, negatively diverging on these stronger time frames. So we're seeing more and more and more of exactly what we expected to see. And where we expected to see it first and heaviest was in the stocks that have done the most, done the best in the first and second quarter, or the first half of 2023, and the stocks that are huge, that have huge positions, the mega caps. So here we see QQQ 3C confirming right into June. Remember, this is a longer time frame, 5 minutes, so it is a stronger signal, confirming right into June, and then boom, negatively diverging. So everything that was covered in this video, and I think this was June 2nd or June 3rd, could be a huge month for the market. Very important month because of these things. Everything basically that we expected to see, from the Fed pausing the rate hikes to the economic indicators getting worse, like the 2-10 spread, the PMIs rolling over, all that, the distribution, where we expected to see it, all of those things have come to pass. So that's why I would say, again, if you haven't seen this already, or if you're not kind of familiar, you don't remember all these concepts, there is hundreds and hundreds of hours distilled into this 30 minutes. You have to participate in your own success, sometimes in your own rescue. I can't do it for you. I am not the guy that is going to feed you trades and say, oh, look how successful we're going to be. That's crap. I've seen it. It's crap. If you want to know, you need to get the information, figure out what works best for you as a trader or an investor, and apply that information in a way that works best for you. That's what I provide. If you're somebody who wants to learn these concepts, I share all of them with you. I share my evidence. I don't tell you this is my opinion. I show you why it's my opinion. Okay? And all these concepts are fractal. So if you're a day trader or if you're a long-term investor, they all work the same. So next week is the end of June. It's also the end of Q2. This is where we expect things to really take a drastic turn. Now, that doesn't necessarily mean the market's going to crash come July. Okay, we have earnings season, but I think earnings season is going to be very illuminating because I don't think forward guidance is going to be so hot. I think it's going to be very difficult to justify the valuations we have now. And I think in the second half of the year, which begins in July, we are going to start seeing the signs of recession, which we're already seeing. There are a couple open questions. So I think EU and UK in particular, which had a 50 basis point rate hike, and they do not have inflation under control. We could see some money flowing out of China, out of the EU, out of the UK, into the US, which could change the kind of outlook short term for the US. I don't know that for a fact. I've seen one day of that this week. So one day is not a trend, but that's something that we'll be watching. And also for most of these funds that have to be invested, it's like, where are they going to be invested? Where are the areas that are going to perform the best? Where are the areas that are going to perform the worst? That is what we do. That's what we look for. So if you haven't seen it, check out this video. I hope you enjoyed this video. And if you did, please give it a thumbs up. Don't forget to subscribe over here and hit the bell for notifications so you know when my latest video or live stream is coming out. If you're not a subscriber to my website, Wolf on Wall Street Trade, you have an opportunity to subscribe right now at 2008 prices before our new website goes online shortly, with a room, trading room for members, and all kinds of other upgrades. But the price will go up because I have not raised prices since 2008. Thanks so much for listening, everybody. Have a fantastic weekend.